So hey everybody, and welcome to today's webinar. I'd like to start off by apologizing for having to cancel so late in the day, so to speak. Last week I had a few personal things come up which just didn't really put me in the right frame of mind to be able to come on here and speak to all of you guys. But hopefully today I'll be able to make up for it. What we're going to talk about in this webinar is basically how to really dial things back in, make your trading that much more simple, which should then contribute to a better overall profit. Because I find that and I know it's a bit cliche now, but what a lot of traders do, particularly new and struggling traders, is in a bit to kind of find that perfect system, right? Kind of eliminate all of the losses, give themselves confidence, or I say give themselves confidence, but I really think that it's trying to get rid of some of the responsibility of their trades. And what they end up doing is they end up putting a bunch of different indicators on their charts. They try and make the system that they're trading really as complicated as possible. And whilst I understand why traders do this, I think a lot of the time, just coming back to basics and understanding what it is that price does and looking at price from a very, very basic level, you'll be able to be more profitable, you'll be able to be more consistent, and also have less stress in the way you go about your trading. And obviously you'll see it written everywhere that price action trading and naked charts is the way to go, and there's a lot of strategies and systems around that. But what I want to do before I talk to you about a particular strategy or a system is I really want to just go over some of the charts and just maybe sort of prove the theory to you and show you that price can actually only do a finite amount of things. And once you understand this, you understand that you don't need 40 million different indicators on your charts to be able to make money. You just need a few lines here and there, and in the long run you'll be able to come out ahead of the game. Now what I mean by a few lines here and there is we're obviously talking about trend lines and horizontal support and resistance lines. You can also use Fibonacci retracements as well if you like. But ultimately, what we're looking to do as traders, we're at the very, very core of it, is we're trying to figure out which way is the most likely direction that price is going to move in. Okay. Now we cannot be right 100% of the time. It's just absolutely not possible. It's never going to it's never going to happen. But what we can do is we can be right more often than we're not, and when we're right, we can make sure that we're making more money than when we're wrong. All right. And we can do this simply by looking at support and resistance levels. So what I've done here is I've got the dollar yen chart in front of us, and I'll be happy enough to put a bunch of other charts up there as well in a second. But just this happens to be the one that we started on. And what I want you to notice here is I put in a resistance level, and this is what we kind of call a key level, because it's a level that price has come up to, multiple times, and it's respected. And every time price comes up to it, there's a little bit of a dance, if you like. There's going back and forth between the level, but ultimately what happens at the level is price either gets rejected or price will accelerate through it. Now imagine you had a trading system where you were to say, all right, that's great with the benefit of hindsight, but all we actually need is one level. So if we were back here in May of 2017, right, all you need is the one level to be able to trade from, because you just need the last time that the price ultimately had a rejection from a level. We're not talking about little things like this here. So you see the market kind of goes up a little bit, down a little bit, up a little bit, down a little bit. No, we're actually looking for levels where price, you can clearly see that there's been some momentum going into the level, and then there's momentum going away from the level. So something like this over here represents a good level for us to be able to trade from. All right. Now, obviously, we're looking at the daily charts, but I can show you how you can take advantage of this in the shorter term charts as well. So what would happen is the next time price comes up to this level, we need to be a little bit wary of it. Now, we don't just take a trade because we fancy taking a trade at this level, although you could. I actually have a friend who was working he's not working there anymore, he's working for a different bank now, but at the time he was working for JP Morgan, and we were talking about certain trades, and he was saying, his basic strategy at that particular moment in time was sell when the market gets up to the resistance level. No real confirmation, no nothing, just the market's respected this level enough, so every time the market gets up there, I'm going to sell a little bit and see what happens. You're not looking for any amazing thing to happen. He's just saying when the market gets up there, it's more than likely going to sell off. If it doesn't, and I'm proved wrong, then I'll get out of my trade. And that's somebody that trades for a big bank. It kind of proves to you that there's no magic formula here, and everybody does the same. So what happens here is with this dollar yen chart, the price comes up to this level. When it comes up to that level, we then need to zoom into it a little bit more. We would obviously look for, we aren't just going to sell because the price gets up here, we would look for some price action. And if we look at the candlestick formation pattern, we could say that, you know, we've got sort of like a spinning top at the top here, so the market's broken through this level. Right, I'm trying to show you it as the price is developing. The market's broken through this level, it's failed to go any further, and it's closed back down beneath the lows. You could then have a strategy where you would say, well, when price actually breaks the low of the candle, i.e. this candle here, all right, when price breaks the low of that candle, I'm going to be in there and I'm going to be short. And what happens? You'd have your stop above the highs, so you've got a very, very tight stop on your hands there. The market sells off from that level, and you can be looking, even if you're looking for one-to-one, within one candle you're pretty much out. But you wouldn't do that. You'd wait for the next support or resistance level in order to get out. So you'd wait for, let's say, 111.81. Okay, that is a profit of about 111.81, 113, so about 180 pips worth of profit, and then you've got 100 pips worth of risk. And that's just from a very, very basic level, right? We're trading price action from a basic level. We're just saying when the market comes back to that level, we're going to trade it. You know, does that work on both sides of the equation? Of course it does. So we could actually have a support level in here as well. And say when the market comes down to the support level, being this guy over here, we're also going to look for some sort of price action reversal. So what happens? The market sells off down to that level. It breaches through it, okay, then it sells back a little bit. And what we could say is that if the market then breaks through, and this isn't the strategy itself, it's just something that you could employ. It's just to show you that simplicity is the best. We could say if the market breaks above that level, we're going to be long with our stop below the lows. Now we could say that now that we're seeing the market gyrate between these two levels, we say, well, you know, maybe we just take profit when the market gets up to that level. So what is that? That is a stop of 107.23, an entry of around 108.50, so what is that, 127 pip stop, so we'll call it 130 pip stop, and then we're going to take profit up at the 11432 level. So you're looking about 600 or 580 pips worth of profit for a 180 pip stop. So you've got a 3-to-1 risk reward. And you know the great thing about this is that you don't need to be monitoring your charts all that much. You just kind of monitor it every now and then and wait for it to see where the market takes you. And because you're trading from these big levels, okay, next time the market comes up to this level, you can sell through it. Okay, maybe you get stopped out from this one here. And the market comes up here again, pierces through, all right, and we get another entry here. We don't get stopped out of this one, it goes all the way down to the bottom. So you can see here, just from trading very, very simple price action, eliminating all of the indicators, just looking for the key levels. How many trades could we have had here? We could have had 1 at the top there, 2, 3 here, all right? Let's call that 4. So 3 and then 4. So we've got 2 trades there, 1 stopped out, 4. So you got 4 trades, 3 winners, 1 loss. And the winners were much bigger than the losers, right? And then do we say that this is a trade here? No, because we didn't get the price action come back within. So where would you have looked for a trade? Well, we would have said if the market, and I talk about this in the circle videos and things like that, about the rejections of levels. We say that if the market rejects this level and closes back within it, then we're going to look for a long. So maybe we could have taken the long when the market closed back within here. Very, very simple, effective price action trading. And would you have had to have held it for a little while? Well, if you wanted to go to the top, absolutely, you would have had to have held it for, where did it go? April, a few months there, but you would have made profit, okay? And the market comes up here, sells below, you could have been a seller there, holding it, price comes down to the lows here. Do you see, look at how many trades we would have had there. So just from trading very, very simple price action, we would have had 1, 2, 3, 4, okay, 5, 6. We would have had 6 trades with fantastic reward to risk ratios. 5 of them would have been winners and 1 of them would have been a loss. just from trading key levels. Okay, big levels. Now the problem with this approach, of course, is that people just simply don't have the patience to trade this way, right? No one wants to wait weeks or months for a position and then wait weeks or months for that position to then kind of come to fruition. No one wants to do that. They want to be in and out of the market as often as possible. They're looking for quantity rather than quality. But you know what? Look at what quality does for you. Look at this. Look at the quality there. Wait for the quality. This stuff just plays out over and over again all over the charts. Okay, now I admit that it's very difficult to do something like that because, you know, we're looking for trades. And even I have a problem sometimes waiting for the right trades because I want to be in and out of the market as much as possible. I want to make as much money as possible, right? Yeah, but does this stuff play out all over the charts? Yes, absolutely. Support and resistance levels. And then you can play previous support becomes resistance. Look at this over here, right? Go to this level, back here. Previous support becomes resistance. So it doesn't just have to be those levels there. We can play it like this. So this is a resistance level. The market broke through it, comes back to it. Okay, gives us a bit of a reversal. We could then buy from this level here. The market will then rally off and pay us. Is it happening again at the top of the chart? Yeah, it does. Well, we don't actually really get an entry here, but there's a possibility. Happens all over the place, ladies and gentlemen, all over the place. But the key is looking for the big levels, the right levels. You don't just kind of trade these little levels willy-nilly, like this here or this here. That doesn't count. You're looking for the big levels where there's been a big reaction. Really as simple as that. And sometimes, yes, you have to wait and you have to go back. But now let's go back in time and let's pick a level back in time and see if it comes into action later on. So this is a relatively big level there. We can say that this is a big level here, and we could say that this is a relatively big level here. All of these levels we want to pay attention to, right? So I'm putting this one in here. Does this come into play in the future? Oh my goodness, look. April 09. After, where did we get into this? You would have identified that in December 04. And 5 years later, that level comes into play and it's respected. What about this low here? May 06. Years later, August 08 comes back into play. What about this guy? March 08. Okay, the market doesn't quite get back up there, but still flirts with it over in April 2010. But what about present day? Oh my goodness. Look at this consolidation area. This consolidation area was all the way back from 2006. This line over here at 101.93. But look, the market's bouncing back and forth throughout this level over here. Do you see that this isn't magic? This isn't rocket science. It's actually simplicity at its best. You guys see what I'm saying here? So everybody's out there looking for those new, wonderful, fantastic systems. You don't need that. And yes, I'm showing you this on a daily chart, but do these things play out on like a 4-hour or a 1-hour chart? Of course they do. Let's go take a look at the 4-hour chart here of the dollar. In fact, let's not use the dollar yen. Let's use something different. Let me go up, down, up, down, up, down, up, down. So randomly pick. Okay, what do we have here? Euro CAD. Does support and resistance work on the Euro CAD? So let's zoom out a bit. Okay, let's put in some levels. And we're looking at it on a different time frame chart, yeah? So I'm looking at it on the 4-hour charts. Well, does it pay attention to levels on the 4-hour chart? Well, in March 2019, the market came up to this level. 22nd of March, a few weeks later, the market came up to that level and sold off from it. What about trend lines? It's not just horizontal support and resistance lines. Look, we're talking about this in my inner circle as well. You see this here, the market has been paying attention to this trend line. 1, 2. Next time the market comes up to this, can you take a bounce from it? Absolutely. Next time the market comes up to it again, can we pay attention? Of course we can. See again there, it just happens each time. Again and again and again, the market just respects these levels and pays attention to these levels. What about the good old support and resistance levels? Well, let's put one in here. So in August 2018, the market comes down to a level. okay, we get a very, very sharp reversal at that level, which is what we want to see. The next time the market comes down to that level, obviously we need to be mindful and we need to look for price action at that level. Now, on the lower time frames, I don't take candlestick reversal patterns. Typically, I'll only take them on like a daily time frame or something like that. So this, I'll be looking for like a 1, 2, 3 reversal, something like this here. So you would get in above this resistance point there for a nice trade. The next time the market comes down, you'll be able to get in again. Okay? So is this kind of proving my point? All over the charts, these things happen. On a longer term basis, on a shorter term basis. Can you trade it on shorter term charts? Absolutely, of course we can. Let's go to a 1 hour chart, right? Go to a 1 hour chart, zoom into the 1 hour chart. Let's go on our lovely magic wheel. Which one do we want to choose? Which ones do we want to choose? What's that? Pound New Zealand. So let's have a look. Does support and resistance work on a Pound New Zealand? We'll have a look at this. Would you say that that's a support level? 1, 2, 3, 4, 5, 6 times the market's come down to it, it gets rejected from that level, right? But was this a level in the past? Oh look, it's a resistance level over here. So could we have projected this kind of price action here? Absolutely. Now, it gets a little bit more untidy on the shorter term time frames. Of course it does. But it's still there. The opportunities are still there. Look at this. Look at that for a level. Like these highs here. So, with this in mind, do you think that you could come up with a trading system that will make you profits in the long run? Look. See that the market's come up to this level. If you know something's going to happen there, you're already ahead of the game, right? Even if you sold blindly or you bought blindly when you get to these levels, you can see that if you pick right, you still have enough of an edge to be able to make money. If you pick right. If you add in a little bit of price action, so candlestick reversal patterns, price action reversal patterns, then you become that much more successful. Your strike rate goes up that much more. Why? Because you're just trading plain price. We're just looking for how does price react to certain levels. As simple as that. Look, it's down at the support level. Can we find anything there? Yes, of course. You could be buyers from this level here. Now, I personally prefer trading price action from longer term time frames. So something like the 4 hour or the 1 hour chart. But that's not to say that it doesn't absolutely work with something like the 1 hour chart. Okay? So it's everybody, the most important part of all of this is really kind of showing you the concept and selling you on the concept, because in terms of the strategy itself, it's very, very simple once you know how to identify these levels and once you believe in the concept, right? And if you don't believe me, let's go back even further. So let's go across to the daily chart again and look at what long-term levels can do for us. Get rid of all of this fluff around here. So let's say that we've got a daily level in and around here. Okay, price action level. Now we've got one a little bit above, then we'll come back to that one here. Okay, the market bounces off that level, breaks through it. What happens years later? May 17, after being a level in October 13. So 4 years later there, this level comes into play. Okay, let's put in another level. So when does this level come into play? This level, oh wow, I thought that it was just 2014, but look, we could have put this level in from back in November 2011. We could have put in this resistance level here, right? November 2011. Where would we have got a trade? We would have had a trade in May 2012, 1 year later. Going forward, we would have had another trade in September 2014. Could have taken another trade in February 2015. Over and over again. The support level, July 2016, May 2017. Get some bouncy from this level in 2018. Again in 2018, all throughout 2018, the market treated it as a pivotal level, right? This is the simplicity. So many people sit there and they they try and make things, nobody sets out to make things complicated, of course they don't. But what they do is that they'll take a loss trading a simple system and they'll think, well, if I were to put in this indicator, maybe I can eliminate that loss, right? That's where they start out. And then they're like, well, if I put in another indicator, maybe I can eliminate that loss. And then it goes from eliminating losses to identifying the trades from the technical indicators as well. So instead of using the technical indicators as being some sort of a filter, they now become a tool for identifying opportunities. They then become a tool for triggering your opportunities, right? So what's happened is it's gone from, maybe you can use technical indicators to filter out certain trades. Maybe you can do that. There's nothing wrong with that. Maybe you can use it to trigger your trades or to help you identify the market context and opportunities. I mean, I've used moving averages in the past to do that. The problem isn't that. The problem is that when you become over-reliant on these indicators and you give up on your ability and you give up on yourself ultimately to be able to take trades and to be able to make the right decisions. Right? You put all of the responsibility on the indicators, and now you're sat there and you're going from the perspective of, well, it's the system's fault. It's not my fault. The system said to do this, I did this, I'm losing money because of the system. They're not thinking about the fact that actually you're the person that created the system. You're the person that put everything into place. You created these filters. You let it go from, I think, to filtering out bad trades to helping you identify opportunities to triggering the trades, to being literally everything about your system. It's you that did that. But we're doing this because we don't want the responsibility of taking the trade. You know why? Because our ego gets involved. Because we don't want the responsibility of taking a loss. And I don't think necessarily for a lot of you out there that it's the monetary part of the loss that affects you. I think it's the ego. I know that to be true for myself. I mean, losing money isn't a problem for me. I know that I can make money. I'm always confident that if I lose a trade, I'll make one back on the next trade. I know that this will happen. The part that gets me is the ego. I'm wrong. I made the wrong decision. Okay, it becomes like this inner battle. You've done something wrong, so you need to fix it. Okay, and by adding indicators to your chart, by making something more complex than it needs to be, what are you doing? You're removing yourself from the decision-making process. Does that make sense? And if you're removing yourself from the decision-making process, then suddenly the market can't hurt you because you didn't do anything wrong. Suddenly your ego is protected. But by protecting your ego, what have you done? You've taken away your ability to read the market because you're reliant on lagging indicators. Now, lagging indicators, they aren't all bad. They can be used successfully, but they can't be the be-all and end-all. If you're basing a trading system, your identification of opportunities, your entry into the markets, your exits into the markets, your filtering of trades, if you put all of that onto indicators, onto lagging indicators, you've got a trading system that's fantastic for trading the past, but not very good for trading the present, and won't be very good for making you money in the future. Does that make sense? Are we all on the same page here? Okay, so what we'll do then is let me talk you through the system. All right, let me talk you through how you're going to be making money. Let's go back to the dollar-yen chart because I had quite a few clear levels I can use to show you for examples. Okay, so for identification of opportunities, it's very simple. We are going to use lines. We're going to use horizontal support and resistance lines, and we are going to use trend lines. Okay? So, horizontal support and resistance lines, what do we want to do? Well, we identify first of all, without the benefit of looking into the future, you identify big levels where prices come and it's either rallied from or sold off from. And we put in a line at these levels. Why? Because this is an indication, not a certainty, but it's an indication that the next time the market comes back to that level, potentially we could have a trade on our hands, right? So what happens? The market comes back to this level, right? We've already discussed this earlier. Now, the entry technique, you can either use your favorite candlestick reversal pattern. So if that be a shooting star, a hammer bottom, a spinning top, a doji, a bearish engulfing, a bullish engulfing candle, you can use whatever entry technique you're most comfortable with, okay? Personally, for the longer term charts, so daily charts, I will use candlestick patterns. So I will use things like spinning tops, shooting stars at the top, hammer bottoms at the bottom to trigger my entry. But you don't have to do that. You could actually, let's put in a vertical line here, and let's see what we could have done if we go down to a shorter term time frame. So let's go back here, this vertical line in, let's go back to, whoops. So we're looking at this level here, right? The market for some reason hasn't put in our line there, but let's do it anyway. Okay. So if we didn't want to trade a candlestick pattern, could we have traded something else? Well, yes, we could have traded a 1, 2, 3 reversal. We could have said, we'll wait for the market to sell off a little bit from that level, then pull back somewhat, and then sell off again. And when it sells off, we will be in on the short side when the market breaks beneath the level there. Now, that gets us in a little bit later, but what you also could have done here is you could have maybe, I'm not a fan of doing this, I would still keep my stop above the highs there, but you could have brought your stop in that little bit closer, right? Looked for some shorter term profits. So maybe don't look for the market to go all the way down to the bottom there, maybe just look for like a 1-to-1 risk to reward or 2-to-1 risk to reward. For example, you could have got in there. Right, let's then move on to the next level. So the next time the market gets down to this level, well, it actually gets down to 17th, what happens? Let's make sure that I am sharing my symbol, time, import and drawings, okay. So let's say 29th of August 17, right? See if we can find this on the 1 hour chart. To go back enough? Maybe. Maybe not. Might be a bit of a challenge. Here we go. Where is that? Yep, we're at the same place. So actually September 17. Can we go down even further in terms of so this is the 1 hour chart. So how could you have played this? The market breaks beneath the level, breaks back above, gives us a little bit of consolidation above here. Could have been in there. Or you could have said, well, no, you know what? I'm going to wait until the market respects this level over here. Right? You could have said, well, I don't want to get in there because that's not really a true consolidation area. So I'm going to wait until the market breaks the high. Because if the market breaks the high here, after breaking below, that's a good indication that the market actually wants to go higher. What happens? It's exactly what happens. The market then does go higher. So hopefully what you can see here is that you can play this from a daily perspective, from the 4 hour perspective, from the 1 hour perspective. The key is to identify the correct levels, the good levels. And the best levels, okay, are the ones where you see proper rejection of the level. You don't want something just to go up to a level and kind of meander along it, sell off a little bit, meander along. You want to see big reactions to a level, right? So for example, if we wanted to move this down, I would say that this is a big reaction. Look, on the 4 hour chart here, we can see that the market clearly sold off towards it, and then when it got to that level, completely rallied off. The buyers completely took control there, right? Completely took control there. So the next time the market comes down to that level, wherever that be, So it came down to it over here, broke through the level, okay, so we didn't get an entry there, but then pulled back to it. Could we have done something here? Absolutely. Could have traded a counter trend line break. Okay, we could have dropped down to a shorter term time frame and played the rejection to that level. Okay, so the market's traded up to this level. You could put in like a counter trend line, for example, something like that. The market's broken beneath it, and then it broke even lower. So you could have played that sell-off. Yes, you would have been in it for a couple of days before it went on to pay you, but it did go on to pay you. Does that make sense? So the key to trading this type of a system, the entry is kind of immaterial. You use your favorite entry level. It really doesn't make a difference. Whichever one you like best, that's the one that you should use, okay? Whichever entry level. But the key is identifying the key levels. And to do that, you want the levels that the markets have clearly reacted to. Okay, because if you can get in at levels where the markets clearly react to it, then you know what's going to happen. Because ultimately, the people in the markets, a lot of them are human beings like ourselves. And if they're not human beings, then they'll be robots that will also take into account things like key levels. Why? Because the markets understand what happens at these levels. There's liquidity around these levels. Okay? So you have the big traders placing stops or entry orders behind these levels, which means that something is always going to happen there. Either, if you're looking at a support level, either the sellers are going to take control and their entry orders are going to push the markets lower, or the buyers are going to look at it and think the price hasn't been this cheap in a long time. Let's get involved here because fundamentally we think that this price is cheap relative to recent price action, relative to the current fundamental outlook, the current economic outlook. Because you need to remember that trading is basically, what's the word for it, not consistent, but a constant polling of everybody's opinion on where fair value is. There's no magic to it. That's what the markets are about. Do you think this price is cheap compared to where it has been and where it could be? If you do, you buy. Okay? Do you think it's expensive? If you think it's expensive, you sell. There's no magic to it. This is what the market participants do over and over and over and over again. Okay? Does that make sense to everybody? So coming full circle back to what we're talking about here, dial things back, make them more simple. Yes, it's going to take some patience, but trade from the key levels. Trade from levels that the markets are looking at, that they're taking into account. Use your favorite entry technique. It really doesn't matter. This isn't a game of perfection, and this is where so many people go wrong. They're trying to be perfect in their entries. They want to be pit perfect. Pit perfect doesn't matter. Being right on the direction matters. Making money matters. Pit perfect, who cares? Are you 100%? No, who cares? Are you 80%? No, who cares? Are you 60%? Yes, maybe, fantastic. Do you make more on the trades where you make money than on the ones that you lose? Oh, you do? And you're 60% profitable and you're 60% right. Doesn't that sound like you're going to be making money? I think so. And that's all you need to be able to make money in this business. That is all you need. Simplicity. Some levels like I've shown you here. Go back, go pull up your chart and put these levels all over your charts. I promise you, you won't be disappointed. Maybe you've done this when you first started trading, but you don't do it now because you're looking for that perfect system. But now's your opportunity to say, I've learned a lot around the markets. Yes, you may have spent 2 or 3 years on your journey. It's not wasted time because you've learned a lot in that time, right? So it's not wasted, absolutely. You can come back now and you can say to yourself, okay, I've learned a lot. Now I'm ready to go back to the fundamentals, to the things that actually work, the things that are actually going to make me money. Okay? Are there any questions? I'm that good at explaining things, I guess. Yeah. Okay then guys, if there are no questions about this, if there's nothing else that you want to know, so to speak, then I'll thank everybody for joining. I thank FX Street and Adinda obviously for administrating this session here. FX Street, you do some wonderful work as always. Sorry again about the last week. It was very, had some personal issues which just made it impossible for me to come on and do this. But hopefully you enjoyed this and you found some value here. I promise you that this is probably one of the most valuable things that you can learn. All traders, whatever walk of life they come from, they always come back to this. Support and resistance levels, buying and selling from these levels. It's as simple as that. Don't make it more complicated. Thanks everybody for joining today. Have a wonderful rest of your week and I'll catch you in next month's webinar. Take care now.